Hi, everybody, and welcome to the Buffett and Beyond Stock Analysis Video Podcast with your host, Dr. Joseph Belmonte, which is me, and Debbie with a Y. Hi, Debbie.
Hey, hello.
And all these methodologies are based on the book Buffett and Beyond, second edition by Dr. Joseph Belmonte and published by Wiley Publishing. And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. Now remember, folks, the clean surplus return on equity is both a comparable and a predictability model and is totally different than the traditional accounting return on equity. So don't get them mixed up. And you can equate the clean surplus return on equity as the interest rate you get from a bank. So this is common sense now. A bank account with a higher return or interest rate will earn you more money than an account earning a lower interest rate. So it just follows that portfolios made up of stocks with high clean surplus ROEs or return on equity will outperform other portfolios made up of stocks with lower return on equity or interest rate. So think of your bank account when we talk about these stocks. The good.
Stocks that should be in our portfolio.
The bad.
Stocks that should be in somebody else's portfolio.
And the ugly.
Oh, stocks that should be in nobody's portfolio.
Okay, let's get on with some stocks. You'll see exactly how this method works and how we here at Buffett and Beyond set the investing parameters so that you, all of you, can outperform most of the professional money managers out there in investment land. And this week we're going over a stock in the broker and exchange industry, and it's LPL Financial Holdings. And folks, this stock is up 250% in 5 years, which isn't too bad at all, is it? And let's look and see what it does. It is the nation's largest independent broker-dealer. In other words, when you have people out there who are in the investment business, if they don't have the top license out there, they have to go to somebody that does have the top license. And even if they do have the top license, they still need somebody or a group or a company to do the back office work and hire the lawyer and the accountants and everything that is needed in an investment office. So they're the largest independent broker-dealer, which is the top license, a custodian for registered investment advisors, and an independent consultant to retirement plans. And they provide an integrated platform of brokerage and investment advisory services, there it is, the back office work, to more than 21,000 independent financial advisors and professionals at 1,100 enterprises, 500 registered investment advisor firms. So those are companies that are registered under this company. And it has 4,756 employees. Now, it has almost doubled the number of financial advisors that it had in 2020, about 3.5 years ago. But it only has another 250 employees. So what it does is as it hires more people or has more people registered under them, they can do it with the push of a button. So in other words, it's like selling newsletters or electronic magazines. Somebody else signs up. All you have to do is push a button to get the original magazine or the newsletter to them. So they're in a nice situation as they take on more and more customers under their umbrella. And let's see how it's done. Just a brief look at how it has grown over or how far above the average stock it is. The average stock is blue, in the blue here, and LPL Financial, which is LPLA, that is the stock symbol. When it comes to the clean surplus return on equity, and think of your bank account. Would you rather put your money in bank account S&P 500 or bank account average stock that's getting you 13.5%, or the bank down the street that's getting you a little bit more than double, in fact? And then when it comes to net income, and this is again 13% for the average stock, 24% for LPL. And then when it comes to revenue, it's bringing in more revenue, about 30% more revenue than the average stock out there. Now, when we look at this a little bit closer, we see back in 2020, now this is
COVID, remember that in 2021, the year right after COVID, we could see that this company up to 2019 was making increasing money every year. Then they slowed down during the COVID years because guess what? Their offices were not open. People weren't coming to work. People were wearing masks. You remember. And clients were not going to these offices at all. And then all of a sudden, 2022, even though the market was down significantly in 2022, remember the NASDAQ was down 34%. This company doubled the net income that was coming in. Now, what's net income? It's the clean surplus earnings. So it's the core earnings of the company's core business. And that's what net income is. It's different than accounting or traditional accounting earnings. So in 2022, it doubled what it did in 2021. And then 2023, up another 50%. And 2024 will be about $16. So the clean surplus ROE, average stock 13.5%. Clean surplus ROE, double that. Retention rate, well, before they weren't growing as much. They were putting about 78% of what they made back into the company to grow. Then all of a sudden they've seen a lot of growth in the past couple of years. So that's what really caught our attention here. Now the net income growth for 2024 is only 6.7%, but it's been averaging 24% a year. I mean, when you come off of growth of 84% and then 44% on top of that 84%, so it's a little slowdown here to 6.7% growth is perfectly normal, folks. In fact, it's still very, very good. And then the revenue growth, again, as we showed, above the average stock, about 30% above the average stock. Years to pay debt, they have almost no debt. Years to pay debt, they could take all the money they're making and use it to pay off debt. It would only take about 3 months to pay off that debt. And it has a very low dividend, which is what we like in a growth stock. We don't want to see dividends in a growth stock. We want to see them take all the money they're making and put it back into the company in order to grow. So let's see what they've done over the past 5 years. Very, very good, up 250%, while the market's up about 75%. Now, you can see in here, while the market has grown in 2023, right in here, this stock has kind of topped out and has gone up and down in 2023, and it's trying to reach the previous peak that it did in the 2022, because look how much growth in 2022 in here while the market was going down. The S&P, black line here, was down 19.6%, and this stock was up what? Almost 60% in here over this year where everything was going down. So people flocked to it. They were putting their money into it. Now it has leveled off. And now, since we've seen that LPLA is a pretty good stock, I wouldn't rush right out and buy it today because we have a little topping action going on here. We have a little short-term sell signal up here, and we may be looking at an overall double top for a while. So this is the 20-day moving average, so keep an eye on that. It'll probably go down and test that. So in other words, today is not the day to go out and buy this stock. I would wait for a pullback on it. But after all, it is a pretty good stock.
Well, JB, I think we've just about covered all the questions sent in by our listeners out there in investment land. And remember, folks, we're here to answer your questions not only about individual stocks, but also about the stock market in general. So keep those questions coming, and who knows, we may even answer a question or two you didn't even know you had. And that's about it for today, JB.
Okay, folks, we had a great day today.
And tomorrow will be even better.
All right, bye, folks. We'll see you next time.
Bye, everyone.
And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. We've had a good week, folks, and here's hoping that next week will be even better. You have a safe weekend, and we will see you next time.